This is our Forex blog for November 9th, 2011. And like most days, we really want to buy the strongest currencies versus the weakest. And it always increases our odds when a currency like the dollar has the daily trend that's up, the weekly trend, shifted up yesterday a little bit before noon, and today also the monthly trend is up. So when all time frames are up and the currency meter is showing plus 80 strength, and especially anytime you see a plus 80 strength with at least 2 or 3 bars, that is an incredible trend, because this tool is made up of 5 different statistical tools averaged together. 3 of them measure the direction the dollar is going versus the yen, euro, pound, Swiss, CAD, Australian, and New Zealand. And obviously, 80 to 100% of the dollar pairs went up today. And it also measures the intermediate time frame intensity of direction. Just like in physics, force equals mass times velocity. I believe in currency trading, the force of the market, the momentum, is made up of what percentage of each currency is moving one way or the other times its intensity. If all the dollar pairs are going up but without much intensity, you're not going to see this reading at or above the 80 level. You're going to see something like this. And these kind of trends may continue or may not continue. Most of the time, when the market doesn't have any momentum or intensity, it chops around and goes sideways. But anytime you see, 2-3 bars above the 80 level, that is a trend that's likely to continue. And especially when, markets don't move one way forever. They go up, and then they either go sideways or they pull back a little bit. They may continue their trend up, or on the next wave up, they go up with less intensity, less than 80 intensity. And you don't know if the trend's going to continue. But if you see the market going sideways or with a little bit less intensity to the downside than the previous wave up, then the last major intense move is likely to continue, which it did here. So again, to summarize, it's very simple. If you see incredible plus 80 strength and as close to the 100 as possible for 1 to 3 bars, and it pretty much is in that direction on all time frames, buy that currency against the weakest one. We have an extremely weak euro today. We have a weak Australian. We have a weak Swiss from here to here for the most part, and about 830 onward. The New Zealand's also weak. So let's start by looking at selling the weak euro versus a strong dollar today. I'm going to take this range bar off just so we can see the whole chart. Notice this currency initially last night is above the hourly moving average, was finding major resistance at my Fibonacci areas I draw each night, and then it broke the hourly right here, and you can see it fell about 30 pips. You have this nice little pullback right here, and these are our intelligent trailing stops, which use our statistical momentum technology. If the market's super weak, we have wide stops. If the market moves statistically too far or the momentum slows up, we tighten the stop. And it got you out of that trade right here. It's 36.71. You were short at 37.98, for a huge 100-plus pip move. And when currencies are underneath the lower bands, you got to be really careful. But on days like this, typically they continue. Looking at the range bars, which I think are vastly superior to the 5-minute charts, we'll scroll back and look at this. Notice the market's kind of going sideways. These are each 30-minute periods. So a range chart is simply a chart that instead of measuring each bar based on time, it's based on pips. This is a 6 pips per bar chart. You can create a chart like this by just going to the ticks per bar and put the number of pips movement, plus the R next to it, or on your chart you can just type in 6R, 10R, 11R, 12R, whatever you want. So this currency, you can see, initially had some momentum, and then during the pullback had less momentum. So you might have even looked to buy this last night. And as it went up, you can see it kind of failed here. You would have had a small loss or break even. And then look at this. Extreme weakness right here. It broke the hourly moving average. And then it's chopping around right here. This is pretty much a no-brainer trade. You short it here. The market was strong before, and unfortunately sometimes trends don't continue. Nothing in the world works 100% of the time. So if you bought this pullback right here, at 29, it starts going up. Your trailing stop has you out here. You lost 4 or 5 pips plus your spread. Big deal. Come on. You're going to have losing trades. If you can't deal with it, you have no business trading Forex. So, you might even some days be wrong more than half the time, but you got 3, 5, 10 pip losses, and hopefully you catch a few 20, 30, 50 pip wins. So you go short right here. When it breaks down, 16, the trailing stop has you out of it here, so you made about 16 pips. And notice the extreme weakness on this counter trend move up. Again, markets don't go one way forever most of the time. More aggressive traders might just draw their trend lines underneath these bars and go short right here because it's very close to the hourly moving average, which is a major resistance area. Most of the time when the markets break from above to below the hourly, you'll see some kind of a retest. I prefer it when they come up to the hourly and kind of chop around and then start to fall, kind of like this pattern here. Very high winning percentage. So you're short again, and if you use our intelligent trailing stops, you're out somewhere at 39 or 40, for a 60 pip win. You also may want to just draw your fibs on this first wave, and again, the first and second fib target tend to be where the market reverses. Now, usually when the market hits the 2.0 band, you're going to get a reversal. It's somewhat dangerous to sell right near this band, but we have the previous day's low right here, which was also a major support area. When it gets broken, there's likely to be some stops. When it's underneath the 2.0 white band, I don't get greedy. I just draw my fibs on here and usually look to get out at the fib target here, which also happens to line up with a monthly pivot. So I would have got out of this around 3,700, shorter around 24 for a 24 pip win. Again, today is just one of those days where the trend just keeps going. You never know if that's going to be the case, so you really should be pretty careful. This one just kept going and going. And this is our 3.0 band. Probably 95% of the days when the market gets to this level and beyond, you're going to get a reversal. When the market is super weak like this, and the other one is showing almost 100 strength for the dollar, I personally wouldn't do counter trend on this. I'd wait for some kind of a decent pullback like this one. It went from around 25 up to about 60. You short here, at least you have a chance. If it pulls back to the previous low, at least you have a good odds of making 30 or 40 pips, which makes risking 10 pips worthwhile. Shorting these little tiny pullbacks, it's not as safe. Notice extreme weakness on the way down, almost no strength. So that's the euro dollar. Let's look at the euro versus the yen very quickly. Same exact thing. The euro is weak, the yen is strong. Boom, down. You made a fortune on it. And notice this one, it really didn't go beyond the 2.0 containment band that much. Went underneath it, shot back up, went underneath it, shot back up, went underneath it, shot up about 50 pips. And that's what typically happens. Now again, the dollar was ridiculously strong today. The Swiss was weak. The Australian and New Zealand was weak. So we'll just take a look at those charts real quick. I like to keep the Forex blogs underneath 10 minutes. So strong dollar, weak Swiss. Guess what? Went up over 100 pips. And notice the 3.0 containment band was where it stopped, which typically is the case. We'll look at the Australian dollar now. Let me move this range chart off top of it. This one, you can see extreme weakness. The counter trend moves have, 1/3 to 1/5 the amount of strength as did the previous weakness. And, notice this nice little pullback here. It was going down with incredible momentum. The pullback momentum had almost no strength. This is right around 3 o'clock here. We'll put the range chart back up, and we'll look at this around 3:30. You have a beautiful trade right here. You're risking 6 pips per bar plus 1 or 2 pips padding. Less than a 10 pip stop. You always want to draw your fibs on there. If the market stalls at the fib target, you want to, at least get out of half. So the fib target in this case happened to be where the monthly pivot level is, and then you get stopped out of the second half right here around 97. You're short up here somewhere around 36. So you made about 35 to 40 pips on that trade. Pretty high probability trade. And notice on this pullback right here, there's no green whatsoever. Even though the Australian dollar went up a little bit, this is a somewhat risky trade, maybe 50-50. But when a currency's this weak, you might want to give it a shot. I don't like to sell underneath the lower 2.0 band. But in this case, if you short there, you have your fib level as your profit target. Notice it touched it to the pip. You short right here at 75. You have a good chance of making 40 or 50 pips while risking 10. And with this kind of weakness, one-way trends, the Australian lately has been extremely weak most days. So you really got to take that shot. In this case, you made almost 40, 45 pips. And that's how you use it. It's a pretty simple trading strategy. Find the ones most likely to continue trend. Wait for a 30-minute to 2-hour sideways rectangle pattern, kind of like this. If it was like this one right here is actually a good pattern. It's weak, it goes sideways, and it breaks down, you go short. Or my preferred method, find a weak currency, wait for a pullback. Preferably it has no strength whatsoever in the opposite direction. This is a no-brainer trade. This is 90% likely to work, and you probably made 40, 50 pips on that trade.